Welcome back to another pipeline trading video. Today I want to go over the key things I'm seeing right now, because once again we have strong confluence, but this time it's across the board. We're starting with the S&P 500. That's the chart we're looking at here. You can't see the open just yet, but we are opening right on that yellow level from the previous video around 651. And right now we're opening below the 200-day moving average. That's not a good sign. It goes back to what I was saying a few days ago. Everything is starting to point lower. Now, when you bring in Fibonacci, the 0.618 level around 614 is where I expect the first real line of defense. What's interesting here is the structure below. We have multiple order blocks. Typically, the first one gets taken out, and the deeper you go, the stronger they become. In this case, we have 1, 2, and 3, and that third one stands out as the strongest zone. Now, why this matters is because of the narrative right now. A lot of people are expecting things to go well. But this is exactly where you need to stay patient and let the market confirm direction. Right now, the higher probability setup is this. Price pushes up and gets rejected at the 20 or 50-day moving average. Look for price to continue to the downside. We're in a downtrend. We've made a lower low and now we're retesting. That alone tells you the direction. Now add in the news flow headline risk is increasing, and that can push things lower quickly. Longer term, I still believe markets go higher over the next few years, but not before a meaningful correction. If you look at history over the last 100 years, we've had about 50 corrections of 10% or more. Around 15 of those turned into bear markets with declines of 25% or greater. So to simplify it, roughly every 2 years we get a 10% correction. Every 5 to 6 years we get a 25% correction. And we're heading into midterms, which is typically a weaker period before strength returns after. So realistically, I'm expecting something in that 10 to 20% correction range. Now, if you zoom out and draw the broader channel, there's still upside long term, but before that, a pullback is completely normal. Even a move down to the 0.618 level around 563 would only be about a 20% correction. That's just a reset. And if we only pull back to the 0.382, that's roughly a 12% correction. Now, if we look at QQQ, it's the same setup. We're already down about 9%. If we move lower, that brings us to around 14%. And if we push deeper into that liquidity zone, we're looking at closer to 22%. And if you look at the chart, that next order block is the key area we're likely going to test. We've already seen a change of character. We made a lower low, bounced, and now we're watching the next move. On the weekly, the key level is the 50-day moving average. If we break that, we're likely heading toward 547. On SPY, we're watching that same idea. If we lose the 50, that opens the door down toward the 640 area. Now shifting over to Ethereum, look at that sell-off. This is exactly why I've been saying to watch the 50-day moving average. For transparency, I've been short in this area, and those positions are currently in profit. I'm holding longer-term positions because I do expect Ethereum to be much higher over the next 2 to 5 years. But in the short term, I'm managing risk. If ETH drops toward 1,300, we could see new lows in related assets. I have stops in place, and I'm staying disciplined. Right now, we're also in a bear flag. Price continues to reject at major moving averages. We've rejected the 50-day multiple times on the daily chart. Same thing with Bitcoin. That's why I've been putting out more videos this week. I want to make sure everyone is aware. If you're not comfortable in this environment, sit on your hands and wait. Let price break, reclaim, and confirm before jumping in. Right now, everything is still leaning bearish. On Bitcoin, I'm watching for 66,000. On Ethereum, 2,000. On SPY, 614. And on QQQ. The weekly 50-day, around 578. On the daily, we've already broken the 200-day moving average and gapped down, opening the door to the fair value gap. Any bounce into resistance, that's where you look for potential rejection and continuation lower. This is not financial advice. This is just a real-time view of what I'm seeing in the market. I'm not blindly bullish, and I'm not blindly bearish. I'm reacting to what the charts are showing. When the 10 crosses below the 20 and price loses the 50, it can lead to aggressive downside moves. Now is the time to stay patient. Sit on your hands and let the market show its hand before making your next move. If you found this helpful, subscribe, hit the notification bell, and leave a comment on what you want to see next. As always, stay disciplined, trade with intention, and God bless.